We all want an uneventful retirement journey. And I don't mean uneventful by no vacations and no birthdays and no celebrations. I mean, we just don't want surprises that take away 20% of our income or make us have to cancel a trip that we wanted to take. What is your best chance for eliminating the unexpected? And the answer to that is to have a plan in place that deals with the unexpected before it happens. A documented strategy. We can do that for you at the Financial Enhancement Group. Go to yourlifeafterwork.com. Get signed up for a next steps meeting. Our team will sit down with you over 90 minutes, give you things that you're going to want to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. Go to yourlifeafterwork.com. Look forward to seeing you soon. Well, good morning and welcome back to Your Retirement Playbook. I'm Joe Clark, your host. Happy to have you along. I was at a meeting, and all of a sudden I heard, and these are 60 entrepreneurs all together in one room, and I heard somebody talk about the change of intellectual property values over the last 20 or 25 years. And he spouted out a number that I had never heard, and at least a third of the room was nodding in approval that that is an accurate number. Well, I will agree that it passed the smell test. But as I began to have more and more conversations with people, they didn't really understand everything that they were getting into. And so if I was going to title this segment, it would be Fickle Fundamentals. Fundamentals, obviously, when you look at a share price or a stock price, are what is the value that that stock represents? What is that company's actual value or worth? And you can ascertain that from many different standards that you want to use. Not everybody agrees on what it is. You hear people talk a lot about price to earnings ratio. That's the stock price divided by the current earnings per share, and that will give you a multiple. So if a stock price is $100 a share and the earnings are $10 a share, then the PE, price to earnings ratio, is 10. If it was $1 that they were earning and it was $100 a share, then the price to earnings ratio, oh my goodness, right, gets out of whack. You want a lower number to be safer, if you will. But how many times does that earnings go into the price? That's what's going to give you a price to earnings ratio. CFAs like Adam Harder, our Chief Investment Officer at the Financial Enhancement Group, would tell you that a PEG ratio is a more important number. He says that, interestingly enough, almost all CFAs would agree that's the number. The bad news is what the PEG ratio is for each individual company is highly disputed. Because they have different ways of looking at what that growth rate would actually be. But it's price to earnings growth rate and much more than just price to earnings ratio in their opinion. But those are fundamentals. One of those fundamentals also is the balance sheet. What is the company actually worth and what's going on? And this is where that conversation came into play. Somebody said intellectual property. That they used and said is now a much larger part of the S&P 500, passed the smell test. But I just thought we would go through this real quick. It shouldn't say intellectual property. It should probably say intangible assets. That's what's really listed on a balance sheet. And that tends to be a combination of goodwill brand and intellectual property. So you got brand value, patents, consumer data, software. Things that change all the time, and I'm going to come back to that. A tangible asset, so the opposite on that. So yeah, those were the intangibles. A tangible asset is one that has a physical substance. Example would be inventory, a building, rolling stock, manufacturing equipment or machinery, office furniture even. These are the two types of tangible assets that go on the balance sheet, tend to be inventory or a fixed asset. So that's really the difference between the two. Now, what becomes very, very concerning for people like me is the change that has occurred from one stage to the other. And again, the theme of this show is an uneventful financial journey. When you look at this in the short term, not much changes year over year, month over month, week over week in the percentages. But when we look at this long-term journey, I am certainly not the person Barb married 34 years ago, right? So the value of intangible assets, and my point would be balance sheets aren't either, The value of intangible assets in the S&P 500 has risen from 17% in 1975. So when you think about that, 83% was fixed or inventory type stuff on a balance sheet for a company. General Motors, steel, buildings, machinery, equipment. 17% was intangible. 83% was tangible in 1975 to 90% of the value being intangible in 2020. The biggest shift actually came between 1985 when it went from 32% to 68% by 1995. So over that 10 years, think .com, the technology surge, is really when the IT movement began. Customer data and software are two of the things listed as intangible assets, and the tech boom obviously has skyrocketed the prevalence of value of these two things to a degree that is almost unimaginable. But those are huge, huge changes. Now, here's where you listening to the radio don't necessarily have the best opportunity that everybody else that's listening. But if you go to our YouTube channel, you'll be able to see this. I'd love to tell you my eyes are good enough to tell you who the source is, but it's up on the screen. But this is a study that was done that just as in a bar graph shows you what is actually going on. The tangible versus intangible assets in 1975, you can see that they're at 17%, working there all the way in 2020 to 10% in terms of what was on a balance sheet. Now, when we go back and we look at the breakdown, again, tangible assets, one of the things that's nice, they say, again, based on the study, they say that tangible assets are easy to value, thick and efficient secondary markets, insurable. All of that is true. I love it when my banker explains to me that we really have, we have no predictable reoccurring revenue or no assets for them to put a lien against, which is very, very true. Our families deal with us quarter after quarter, year after year because they choose to, not because they're contractually bound to, as opposed to having the steel or having the inventory or having contracts where people are forced to complete the deal. An intangible asset, on the other hand, is difficult to value, thin and inefficient secondary markets, and they're difficult to insure. So think about this. The patent for the horse and buggy exists, but is it of value today? The patent for the first rotary phone exists, but is it valuable today? Some of you will remember Lucent Technologies. Lucent sued more people every day than it had competitors inside of the communications device. I used to laugh about it on CNBC. I couldn't believe it. They were constantly suing people for violation of one of their patents inside of the communications divisions. You've heard all of the suits between Apple and other companies over who owns the intellectual property. But part of that deal is it simply does become outdated over time. So when you look at the price of a stock, and I call it fickle fundamentals, you have a couple things to consider. You have the value. What is the underlying company really worth? And then the second is, what is the current price going? And here is where I think we have to acknowledge some changes. And this is going to get to my age to a little bit. But, I was born in Muncie, for those of you from central Indiana. And I was born at a period of time where going to Indianapolis, I'm telling myself, to get White Castles, that my grandparents loved them. We didn't have a White Castle place in Muncie or Anderson at that time. And we would drive all the way to Indianapolis with my grandparents to go get White Castles. There was no Interstate 69. There was State Road 67, I believe it was, that we'd take all the way to Indianapolis to go to White Castle. Eventually, the interstate was developed and formed, and now I wouldn't think about going on 67 unless I had to, or I wanted to see the pink elephant on the side of the road, right? The bottom, you have to live around here to understand that. But the bottom line is when something material changed, I need to change the way, or we needed to change as a family, the way that we process stuff. The theme of the show is the uneventful financial journey, and I told you if you're planning a path to Florida, you can go the route of South Carolina or you can go the route of Nashville, but you can't change from one to the other midstream. And in my opinion, that's really what emotions do to people. They wreck retirements. I wrote about that a few weeks ago in one of my articles. They wreck retirements because people respond to short-term events with massive amounts of emotion. When I talked about the trip that I took to Chicago and I said it was uneventful, I left my house, I made it to the meeting all on time, everything was good, but I left out that I almost ran out of gas because of a traffic jam, and I left out that I almost got ran over at a toll booth by a guy that was driving out of control. I left those two things out. When we look at your financial journey, at your life after work, it's hopefully you're going to deem it uneventful, but I promise you, ladies and gentlemen, you are going to have moments like a tech wreck. You're going to have moments like 9/11. You're going to have moments like a pandemic. Hopefully we never see an 08 and 09 again, or a 9/11 again, or even a tech wreck again, but we probably will see stuff like that. We've got to be prepared for those kind of things. You've got to be prepared in your process to recognize when you're making a change, when you're going from State Road 67 to an interstate, and when you're making a change because of emotion. When I show you this chart of intangible assets versus tangible assets, and the changes that have occurred over the last 25, 30 years, I believe it becomes very, very important for you, if you're doing this on your own, to make sure that you document what your investment policy statement really is. What is your process? How are you going to make changes? When are you going to acknowledge that this is a change that's being made by a material change of information? And when are you making it based on a response merely to a current stock price, right? If you don't have an idea or an understanding of what the value of the company is, right, then that's okay if that's not part of your process. But if it is part of your process, you have to acknowledge intangible values are much different today than they were in 1975 or even 1985. You know, what is that valuation methodology that you're going to use and document? You know, we have to comply with SEC regulations. We've got more than $100 million, more than $650 million at the time of this recording we're responsible for, right? We have to document. That keeps us in compliance with government regulations, and those are necessary regulations. Sadly enough, many of you who do this on your own do not have a documented investment policy statement. That is one of the things you should do. Just like you know the map of the route you're going to take to get to Florida, you need to map out your path, your plan to be able to get to your hopefully uneventful financial journey. Hey, go to yourlifeafterwork.com or call us at 800-928-4001. Get signed up for your Next Steps meeting. That 90 minutes could make your trip much, much more enjoyable. If nothing else, it can remove a few of the unnecessary and unexpected events. yourlifeafterwork.com.